Okay. Okay, so as I said, this is a summary of what an income statement entails, and you'll all come to realize that the income statement realistically is just made of, it's a squeezed version, is an expanded version of what you are seeing here. We look at your revenue less cost of goods sold, which is made up of variable costs, because your cost of goods sold is called ideally a variable cost. Then that gives you your gross profit. Okay, then when you remove fixed costs, it gives you the profit. So even if you didn't know how to come up with an income statement, even if you knew it up to here, I can say thank you that you are now already redeemed. You've now joined the expertise of understanding how your business performs. But we also categorize it this way because it allows the business to make strategic decisions. Is it that we are spending a lot on our rent? Should we change our location? Because fixed costs, they do not influence. Maybe I need to invest more in things that are making money. So you would find maybe people have space and they have been locked down of COVID and they are crying, oh, lockdown, my business has stopped and I'm paying rent, which you don't need to pay. You can have your goods at your home there in the warehouse there, and you sell because if you can deliver to your customers, probably those fixed costs can be managed. So these are some of the logics that some organizations use to actually navigate some of the different scenarios, just by understanding, this one is, okay, do we really need to meet this cost? Should we, do we need this? Yeah, so based on that, and you'll find that's why some organizations work on, when they have workers in production, they say, we are going to pay you as per your capacity. If you want to work 24 hours, it's fine. Me, I'm willing to pay you as long as you are producing. If you want to produce 500 tons, work overnight, I don't want to control. You know your budget. You can budget how much? Me, I'm paying you per unit like this. And you say, and you'll find people working like hey man, today I have to make 50,000. Nina mbaga. I have to make 50,000. But technically and strategically as a business, you've already assessed. If I put that variable cost, I can increase my production. I can incentivize production by handling my variable cost. So, ladies and gentlemen, that is just a basic introduction of how our income statements start. Okay, so we are going to specifically our documentation or income statements. I'm going to be navigating through this book and also my slides, but the slides didn't have break even, so I thought I just needed to at least give you that intro for purposes of you understanding where we are coming from and where we want you to go as a business. Feel free if you have a question, but I now want to go on the three statements: income statement, balance sheet, and cash flow. We may find ourselves covering income statement, and we shall see how far we shall go by 11:30. Any questions so far? Barbara, please feel free to ask.
I missed out the first calculation. Now this brings my question, like what are the variable costs?
Nga, you have killed me. Where did you miss? Barbara, kindly guide me. Where did you miss? Did you miss examples of variable cost? Or what exactly did you miss?
No. Okay, when you started like introducing the break-even point, I missed that whole part. I think it is the network issues. Then I joined in when you were explaining the multiple products, when someone is providing multiple products, more than one product.
Okay, so I may not be able to repeat all that, but I can, since we have recorded, we'll certainly share. But just for your interest, I'm going to try and just do a scan through. A scan through. And ideally, I explained what fixed cost and variable cost. We said fixed cost changes with change in production, increases or decreases with production. Fixed cost, whether you are producing or not, it stays the same. Okay, so if you're paying a salary, whether the person has worked or not, it has to be paid. If you're paying a wage based on production, then that is the variable cost. I hope you now get the meaning. And the examples are here: direct materials, supplies, anything related to production materials, raw materials, transport, anything there, packaging material, labor, if it is based on production, rate of production, electricity, if it is based on production, wear and tear, based on production, delivery, based on production, and commission on sales. Though the way we handle commission on sales statement is we remove commission. We handle it a bit different, but it's a variable cost. Okay, then for fixed costs, we gave you an example of rent, marketing, advertising, insurance, your license, legal fees. When you register, Barbara, okay, whether your business will work or not, that is a fixed. There is a cost that will incur. Are we together? It's not dependent on how much you will produce. The cost for you to pay URSB to register are we together? So that is ideally what I meant. I hope that makes sense. As long as you understand this, the rest we shall. Yes. All right. Okay, thank you. Okay, so now we are going to go into the income statement, and I'm going to share a different screen. Yeah, where is this screen? Yes. Okay, let me just 1 second. 1 second, 1 second, 1 second. All right. Oh, this is the wrong screen. This is the right screen. Okay. All right. Let me share. So I'll be explaining a few things, and I'll also be using the book just to give more insights. Okay, so my slide is here, and we are good to go. These are the commonest, we call them three statements. We have the income statement, and I explained a compressed version from the variable cost and fixed cost, a compressed version of what an income statement summarizes. Okay, an income statement is basically made of revenue minus expenses, but we have categorized these expenses. Why? When you categorize, you'll understand the business a bit different. Usually there are costs you can control and there are costs you cannot control. Okay, so income statement this is a summary. If you just needed to understand what income statement is, that is the summary, that is it. A balance sheet. The balance sheet has an equation. Assets is equals to liabilities plus stakeholders' equity. Now, some of you may need me to explain what an asset is. So I'm just going to see if I can explain to you what an asset is from this book I've been working on. But an asset is something that has value. It can be converted to money maybe now or later, but it has value. You can convert an asset into value, but it can also be value. For example, cash is value, is an asset. Stock or inventory is an asset. A vehicle is an asset. Machine is an asset. And what the balance sheet is simply saying, assets, whatever you have as an asset, whether it is stock, whether it is cash, it is equal to any money you have borrowed plus the money you've contributed in business. Okay, so some of us start with a loan, or some of us start by putting money in the business. So we put our own money and buy stock and put some cash there. You'll find the equation is always the same. Whatever you buy and put in the business, okay, becomes an asset. But where did this money come from? It came from a loan, or from your pocket, because the stakeholder is you, your contribution. So it can either be external or internal, but whatever is there is equivalent to either what you borrowed. So what you borrowed can be 0 plus what you contributed, which can be more, or what you borrowed plus what you contributed. I hope we can all agree to that. Okay, so just as long as we know these equations, the rest you will see the tables and the items, but in principle, this is what we're talking about. Then the cash flow statement is simply, it simply shows the liquidity of the business. How is money, the flow of money, cash from operating activities, cash from investing activities, and financing activities. What are our operating activities? So during operation, so operating activities, we usually get our income, I mean our loss of profit. That is usually the result from operating activities. Okay, cash from operating activities, we are either making a profit or a loss, so that comes here. So when we calculate our income statement, that net profit or loss will come into our cash flow statement. Okay, and then usually we get an addition item, depreciation, because we've not used that cash and we add it. So that becomes cash of our operational activities, money that we've used in our operations. Okay, then cash from investing is sometimes we buy or sell an asset. So you may have a vehicle and say, this vehicle is now costing me too much, I need to sell it. Okay, when you sell, it becomes cash from investing activities. You sold and brought in money, or you bought. All that comes here. Okay, we shall see the table later, but I'm just giving you how we categorize. Then cash from financing activities. If you borrow a loan or you get equity partner, we shall explain that in our later discussion. All that fall in the cash flow statement. When that money comes, or when I pay back part of this money, all that is captured in the financing activities. So in a nutshell, those three statements are in this nature. And that summarizes everything we shall do on those tables. Okay, for some of you who are given the template and you're working on your balance sheet, it basically works in this principle. Okay, now for purposes of examples and knowing what items etc, I'm just going to try and explain a few of these examples. We shall start with our I'm going to capture I'm going to explain examples from our sorry, let me first confirm which page I'm gonna use here. Right. Okay, so because one of the expectations in the beginning, I realized you want to know the terms. That is a serious task, helping you know the terms. So I cannot proceed without you knowing the terms. So let me try and use this book to try and take you through some of the terms. Okay, and feel free, ladies and gentlemen, it's for your own individual benefit. Do not get lost and feel like you cannot ask even what you consider a simple question. Feel free to ask. It is this is your session for you to understand some of these things. So I'm just going to explain some of these terms, especially as we go through the documentation. Yeah, so this is where the content is. The income statement, as we said, is also known as the profit loss, the trading profit and loss statement. Some of you call it, okay? I know it is in the curriculum for some of us. Then, and the income statement basically shows the performance. Some of us, we went to school. I believe all of us went to school. You would always have a report card. Yeah? The report card is the performance, your performance. Okay? So that report card is your performance. Okay? But the balance sheet is your status. As at this time, is it that you now, they may have given you results based on how you performed, but as at this time, maybe you revised and now have improved. the balance sheet is your status as at a given time, while profit and loss is performance over a period of time, maybe a year, a month, a week, whatever, usually a year. So the income statement is over a period of time. So you'll find what is our income statement for 2021 or 2019, 2020. That is a period. How did we perform over this period? Okay, then you'll hear balance sheet is the balance sheet as at December, November 2021. It means at that particular point, our assets are like this, our contribution to the company is like this, and our loans, if any, are like this. That is the status at a particular time. That's why you are seeing, they are saying here, or I am saying here in my whatever, that an income statement is like a continuous movie. Okay, it's basically like a report over a period, term 1, term 2. Okay, in fact, by explaining this, I think the report is a better example. While a balance sheet is the status as at, the status of my knowledge probably as at this time. Okay, and then these two statements, if you know them very well, the cash flow is a derivative of the two. Okay, the cash flow statement basically, in summary, is cash in, cash out, but it is a derivative of the two. Okay, feel free to ask any question. So because I'm just keen on ensuring you understand the terms and I'm explaining the terms, yeah, so I've explained about income statement. And what is revenue? Revenue is something earned or given. Some of us are given grants that can as well become a revenue or an income, but it's categorized as other income. Okay. While expenditure is something that is spent or owed. Okay. We spend, it's money going out, we spend, it's an expense, we spend. Then you will come across a term, selling, general and administration. It's just a summary of overhead expenses in an organization. These are non-production costs, or what you would summarily call fixed costs. Okay, so I can easily say these are also fixed costs. Okay, so what I shared as a simplified, compressed version now becomes something like this. Okay, this is how an income statement looks like. Okay, this is how an income statement structure looks like. You'll find it is sales, what I have sold, then other revenue. If you have got a grant somewhere, Rebi has given you some support, it comes in there. Then you put that as total. Then you remove the then raw materials, packaging, all those are variable costs. And when you total them, they come to cost of goods sold. And that is when you get gross margin. Then you remove the fixed costs. Now we are making it, we have just expanded it, calling it SG&A, but all these are fixed costs, salaries, marketing, what. Then it will give us a figure called earnings before interest, taxes, depreciation, amortization. It's another level of profit. Okay, but it includes depreciation and taxes and interest. So when I remove depreciation from that amount, it becomes earnings before interest and taxes. That means I've removed depreciation. Then if I remove interest, that means I took a loan. Now I'm removing the interest I'm paying back maybe to the bank or to the financial. Then it will show earnings before taxes. Okay. And then when I remove the taxes, then it becomes a net profit or a net loss. As long as this is negative, you cannot remove taxes when you're not making money. Okay. Now there's a reason why financial expenses are removed before taxes. So you'll realize, I don't know if some of you have read a book by Kiyosaki. I don't know if it is Rich Dad or his book. He always says he doesn't pay much. He doesn't pay much taxes. And also, I don't know, you people follow the politics of USA. You used to hear they're saying, no, this Trump is a billionaire, but he's not paying taxes. Why is it? This man is a billionaire, he's not paying taxes, or he's paying very little taxes? Why? It is because we remove financial expenses before we remove your taxes. So you may find, as much as he's a billionaire, he borrowed money to use the money. So when he borrows money, since he's paying a lot of interest, rarely does he pay a lot of tax. So some organizations use that to actually reduce the amount of money. They borrow money to ensure that, yeah, they are liquid, but it also reduces the amount of taxes they have to pay to the government. And that is just an accounting aspect that you may need to be aware of. Okay. Now let me go back to my slide. I hope I've explained some terms of the income statement. Feel free to ask if you have a question there. All right. Okay, so I'm just going there. So this just still emphasizes income statement reports primary measure of the economic performance of an accounting period. An accounting period can be a month, a year, okay? Balance sheet reports the financial position of an accounting entity at a point of time, okay? Cash flow, basically cash during the accounting period in categories of operating, investing, and financing, okay? So that is what summarizes an income statement. We put what comes in and what goes out in terms of expenses. And that helps us know, have we gained money or we have lost money at the end of the day? Okay. What I just showed us is exactly what you are seeing. Revenue minus cost of goods sold, or revenue minus variable cost, total variable cost of a particular period. It gives us the gross margin. Then we remove the fixed costs, and that can be categorized in terms of service expenses, human resources, marketing expenses, SG&A. All those are basically fixed costs, and they bring us earnings before interest, taxes, depreciation, and amortization. I want us to know standard terms on the income statement, because usually you'll find an investor asking, I want a company that is making about 50 million EBITDA. Now you ask, EBITDA. So EBITDA means earnings before interest, taxes, depreciation, and amortization. Okay. Recently, I was speaking to a financial in Kenya, and he was asking, Roy, can you share with me at least some profiles of companies led by a young person or women in agro-processing that can absorb $330,000? Okay. Their EBITDA should be positive. That means they should be positively making profit. Okay. They should have some profitability after removing these operating expenses. That is basically what is meaning. And you'll find this term EBITDA. So, and that's why I'm just involved EBITDA, earnings before interest, taxes, depreciation, amortization. Depreciation is when your physical assets reduce in value over time. Amortization is things we do not see, but they reduce over time, okay, in value. Okay, for example, if I have a patent over time, the value goes down because when it expires, people now can copy what I do. Okay, so EBIT is earnings before interest and taxes. EBIT is earnings before taxes, and then profit and loss. That is the structure of an income statement. And you'll find we are going to use that when we do financial modeling. Okay, what I sent you as financial templates were to now give you an intro into what we are going to do. All right. Sorry, there seems to be some background noise. Ladies and gentlemen, if you have a question on income statement, please do ask. Let me just want to see if I can give you an example so that you actually see when we say okay, so that you can easily okay, I have an example here. Right. Let me share my screen.
Roy, can I ask a question?
Please do ask a question.
Yes. How do you calculate the depreciation?
That's a very good question. Nae, can I answer your question later? We shall calculate depreciation when we do. Okay, so I want us to know the basics. How we shall calculate the Excels that we are going to share will sort of help us. So you don't need to master some of these formulas. Some of the templates will have it covered. The most important thing is knowing what goes behind the curtain, just for typical understanding. So I don't want to make it complicated, but to answer you depreciation, we look at the value now minus so for example, if I bought a vehicle at 50 million, okay, and I say its lifetime value, its life, usually, I know you've seen MTN sell double cabins, you've seen URSL vehicles. Usually when they buy the vehicle, they buy at a certain amount. Then they say, this vehicle will be useful to us for only 5 years. When they say it will be useful for us in 5 years, I can just simply divide, okay? The simplest term will be just to divide, and I will see that the depreciation is about 10 million, okay? In simple terms, but you can decide and say, it will be 50, I've bought it at 50 million, but by the end of 5 years, it will be worth 5 million, okay? So you divide 50 minus 5 over 5, okay? Either way, the figure is still acceptable, okay? But for the interest of members, it's not so, we shall sort it out towards the end. You'll see how it comes in. So I wouldn't recommend you worry so much about it. All right. Kalulu, you are saying I reduced my speed. Where? I don't know. I thought I was slow, but if you've lost me anywhere, please feel free to just let me know so that I can provide appropriate guidance. Okay, so that is the basic structure of an income statement, ladies and gentlemen. Okay, and I wanted us to understand these terms because we shall find them frequently. EBITDA, 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 and financials like that, EBITDA, earnings. So if we have never come across, now you should know. EBITDA means earnings before interest, taxes, depreciation, amortization. Okay. So from revenues to EBITDA, we are just saying revenue minus cost of goods sold. And cost of goods sold is basically what we looked at as your variable cost towards production, raw materials, packaging, okay? Then when you remove you get your gross margin, you remove operational cost, most of them are fixed cost, you get EBITDA. Still emphasize, EBITDA. Very interesting. So this is an example, let me just try and... So this is a hub company. A tea hub company in Kenya, okay? Its revenue in 2015, this is their income statement. They say they sold tea, they sold jam, and then they got other revenues. Their total revenues was 250,000 Kenya shillings. Then their raw material for whatever they sold, they spent 39,245. Their packaging material, they spent 31,000. So their cost of goods sold was 70,224. I hope you can all follow. So 70,000 is a summation of this, while 250 is a summation of this. Okay. So once they did that, they got their gross profit or their gross margin. That's what you can see. That's 75. Then now they remove the expenses. So they just categorized the expenses, which you can categorize, you cannot, whichever way, they are all fixed expenses, as I put, based on that principle. I just want us to understand the principle. So he put service expenses, human resource where salaries fall, marketing expenses, then other company overheads, and it came to, now he just subtracted in, it came to 55,500. Then his EBITDA, earnings before interest, taxes, depreciation, amortization, was 124 to 55. Okay, then his depreciation or amortization came to 18,181. And then he got his EBIT, earnings before interest, as 106 and 74 shillings. Then he didn't borrow, he didn't have a loan, so his financial expense was 0. So in his earnings before taxes was 106, and usually, I think both here and in Kenya, the corporate tax is 30%. So he calculated his corporate tax, and that is his profit, net profit or loss. If he had a loan here, the tax would reduce. I hope you now understand some of this. May I ask if there is any question about income statement and on the terms involved in the income statement? Anything you need to understand on the income statement? So most of it you'll find in this structure, but because I showed you how to you may find I decide not to put this on the income statement. You may find we just go with revenue, cost of goods sold, because there are some things we can do and just have a summarize. But that is as and when. But I want you to know the principle, the basic that brings that income statement out. Okay. If there is no question, I would want us to absorb this. So we'll take a 5 minutes break, just to allow you to understand the flow. And if you have any questions, I would be able to attend to them now, for purposes of ensuring that we are all on the same page. Ladies and gentlemen, if you are lost for any one reason, feel free to ask. I'm happy to respond or repeat, just to ensure that you understand this part. All right, we have a 5 minutes break. Whether you want to capture some notes or whatever, or you want to freshen your head, yeah, you have it for yourself. Thank you. And I'm still receiving questions, whether on chat, just in case. Feel free to let the questions come through.